Good morning, ma'am. My name is Pulkit Verma and my roll number is 19152. My class is BMS 3C and the topic for my today's presentation is insider trading. So I'll start with the basic question that what is insider trading? Insider trading involves trading in a public company's stock by someone who has non-public material information about that stock for any reason. Insider trading can be either illegal or legal depending on when the insider makes the trade. Insider trading is illegal when the material information is still non-public, and this sort of insider trading comes with harsh consequences. Before we go deep into understanding insider trading, it is important for us to first understand the basic terms related to the concept. What is insider information? Insider information is a fact about a public company's plans or finances that has not been yet revealed to shareholders and that could give an unfair advantage to its possessors if acted upon. Buying or selling stock based on insider information can be a criminal offense. Insider information is usually available to executives working within or close to a public company. Second one is insider. Who is an insider? Insider is a term describing a director or senior officer of a publicly traded company as well as any person or entity that beneficially owns more than 10% of the company's voting shares. For purpose of insider trading, the definition is expanded to include anyone who trades a company's shares based on material non-public knowledge. What is the rule of 10b51? Rule 10b51, established by the Securities and Exchange Commission (SEC) in 2000, allows insiders of publicly traded corporations to set up a trading plan for selling stocks they own. It is a clarification of Rule 10b5 set under the Securities and Exchange Act of 1934, which is the primary vehicle for the investigation of securities fraud. Rule 10b51 permits major holders to sell a predetermined number of shares at a predetermined time. Many corporate executives use 10b51 plans to avoid accusations of insider trading. Now we'll understand the basic meaning of insider trading. Material information is any information that could substantially impact on investors' decision to buy or sell the security. Non-public information is information that is not legally available to the public. The question of legality stems from the SEC's attempt to maintain a fair marketplace. An individual who has access to insider information would have an unfair edge over other investors who do not have the same access and could potentially make larger unfair profits than their fellow investors. Illegal insider trading includes tipping others when you have any sort of material non-public information. Legal insider trading happens when directors of the company purchase or sell shares, but they disclose their transaction legally. The Securities and Exchange Commission has rules to protect investment from the effects of insider trading. It does not matter how the material non-public information has received or if the person is employed by the company. For example, suppose someone learns about non-public material information from a family member and share it with a friend. If the friend uses this insider information to profit in the stock market, then all three of the people involved could be prosecuted. Legal stances of insider trading. The term insider trading generally has a negative connotation. Legal insider trading happens in the stock market on a weekly basis. The SEC requires transaction to be submitted electronically in a timely manner. Transactions are submitted electronically to the SEC and must be disclosed on the company's website. The Securities Exchange Act of 1934 was the first step to the legal disclosure of transactions of company stock. Directors and major owners of stock must disclose their stakes, transactions, and change of ownership. Form 3 is used as an initial filing to show a stake in the company. Form 4 is used to disclose a transaction of company stock within 2 days of the purchase or sale. Form 5 is used to declare earlier transactions or those that have been deferred. The term insider trading generally has a negative connotation that is based on the perception that it is unfair to the average investor. Essentially, insider trading involves trading in a public company's stock by someone who has non-public material information about that stock. Insider trading can either legal or illegal depending on whether it conforms to SEC rules or not. When is insider trading illegal? Insider trading is deemed to be illegal when the material information is still non-public, and this comes with harsh consequences, including both potential fines and jail time. Material non-public information is defined as any information that could substantially impact the stock price of that company. Obviously, being privy to such information could influence an investor's decision to buy or sell the security, which would give them an edge over the public who do not have such access. When is the insider trading legal? Legal insider trading happens in the stock market on a weekly basis. The question of legality stems from the SEC's attempt to maintain a fair marketplace. Basically, it is legal when company insiders engage in trading company stock as long as they report their trades to SEC in a timely manner. The Securities Exchange Act of 1934 was the first step to the legal disclosure of transactions of company stock. For example, directors and major owners of stock must disclose their stakes, transactions, and change of ownerships. So now we'll move forward with the key takeaways from the presentation. The first one is insider trading is the buying or selling of a publicly traded company stock by someone who has non-public material information about the stock. Second, material non-public information is any information that could substantially impact an investor's decision to buy or sell the security that has not been made available to the public. Third, this form of insider trading is illegal and comes with stern penalties, including both potential fines and jail time. Fourth, insider trading can be legal as long as it conforms to the rules set forth by the SEC. Thank you, ma'am. That's all.